Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the most famous contrarian covers of all time is the Business Week Death of Equities cover. And again, as we talk about sentiment, one of our favorite bigger term sentiment indicators is magazine covers. And it doesn't, I know again this is an ETF presentation, and I've got some good examples on ETFs and then sectors in general with magazine covers. But again, just taking a bigger look at the overall stock market. This cover is famous because it came within about a year and a half or so of the ultimate bottom in the early 80s and then a spectacular nearly 20-year rally in equities. What's nice about this cover, though, is if you take a look at it, look at this one here. This is a Time magazine cover. And in Bernie's opinion, this could go down as another major contrarian cover. It came out in late 2009, and it's why it's time to retire the 401k. So you've got a market that obviously at the time, late 2009, was well off its lows, but an extremely skeptical magazine, very similar to Death of Equities in our opinion. And what stands out on these two covers really, at the time of the first one, Death of Equities, there were negative 10-year returns, also 3 straight years of equity mutual fund outflows. That makes sense. The market was doing very poorly in the early 80s, so people were taking their money out and did not trust the market. And you fast forward to 2009, what do we have? Negative 10-year returns, and again, 3 straight years of equity mutual fund outflows. That's the first time it's happened since the early 80s. And I know the argument on mutual fund inflows, outflows is obviously a lot of Gen X and Gen Y investors have never seen a positive stock market, so to speak, on a longer-term basis. They simply don't trust it. Also, a lot of the baby boomers are taking their money out of the stock market, or at least out of equities, and into safer instruments. And I can't disagree with those arguments. At the same time, overall, from a sentiment point of view, when you see a cover like it's time to retire the 401k not that long ago, that's such a potentially powerful contrarian indicator just from the point of view of the overall sentiment toward the stock market. We think it could have very, very long-lasting effects and potentially much higher prices. And that's happened since then, and we still think it's very powerful. Now, just for fun, just a note, you talk about magazines and people that make mistakes. Here's an little one. If the Leno show works, said former CNBC President Fred Silverman, it will be the most significant thing to happen in broadcast television in the last decade. And look at this. The Jay Leno experiment is now considered, the 10 o'clock Jay Leno experiment is now considered to be TV's biggest bomb ever. But getting back to the magazines and how you can make money from them, it's interesting if you think back a year ago at this time, there's a lot of talk about the euro and how it potentially might not exist. And let's be honest, 5-10 years from now, maybe the euro doesn't exist. But definitely the last year around this time, I think there was a lot more talk that the euro would not exist. As you can see here, here's a Business Week, a Bloomberg Business Week cover. It says, uh-oh. And again, it's talking about the euro. The euro was down about 20% in 6 months. Also, it had a 50% retracement of a decade-long bull market. So you had a very oversold instrument, in this case a currency. And on a technical point of view, the 50% retracement was a potential area of support. And then you throw in the negative magazine cover. Also, The Economist had this cover right around the same time. Can anything perk up Europe? Now, when you see things like that, it has a funny way, from a sentiment point of view, of marking major potential buying opportunities. And interestingly enough, the euro bottomed the exact same week as this cover. So you can see in early June that bottom, the FXE, the Euro ETF, and it had a significant rally the next few months. And currently, the FXE is actually up to 145. And it just broke out again today. I believe its highest level since December of 2009 today. So it wasn't that long ago. It was the end of the world, the end of the euro. And, with a little bit of positive price action in early June, all that negativity can unwind, and you can have a really nice longer-term trend, longer-term play. Commercial real estate. We don't think there's probably any hated sector more so than commercial real estate a couple of years ago. There were numerous bearish magazine covers. And again, at the time, I couldn't really argue with a lot of the fundamentals because the fundamentals were very poor for the group in general. But off of the March 2009 lows, there was some very, very strong price action in commercial real estate, specifically the IYR. That's the REIT, the large commercial real estate ETF. And nonetheless, we saw a lot of skepticism on this bounce toward commercial real estate. And you see this cover here, Deep Trouble, Why the Commercial Real Estate Crisis Looks So Scary. And actually heading into 2010, commercial real estate was our favorite sector. And again, it was because we had such strong price action, but also against such incredible negativity. And at the end of 2010, interestingly enough, commercial real estate was one of the strongest performing sectors. So this is how, when it comes to ETF and sector plays, these plays don't always line up, but you need to be aware of, magazine covers and what the overall prevailing sentiment on things are. And this is, I think, a really good example of how that can work for you. A more recent magazine cover that came out with some pretty extreme sentiment, we think, is this Business Week cover. It came out this past summer. Amber Waves of Pain. Do not buy commodity ETFs. And it actually says that 3 times on there. Now, if you actually read the article, though, it's not necessarily bearish. Commodity ETFs, what it's pointing out is how the commodity ETFs don't necessarily trade with the overall price of commodities. Nonetheless, by no means does that look like, to us at least, a bullish magazine cover. So that's something to consider. And look what happened here. Here's potash, one of the largest commodity names out there. When that the blue arrow is when the magazine cover came out. Potash jumped, and then jumped significantly for about 2 weeks. And then you had the massive spike higher on a buyout. So that's one example. Now looking at the ETFs, the agricultural ETF, DBA, you can see by the blue line there, that's when the magazine came out, talking about don't buy commodity ETFs. And interestingly, commodities did very, very well. Also, the ISE Global Copper Index is another really good example. Copper is obviously a good commodity, and that is very similar. That bottomed in early August also and did very, very well and continues to do well. So that's another way you can play these ETFs based on overall negative sentiment in the magazine world. In 1950, the Monaco Grand Prix, Juan Manuel Fangio, he's widely considered to be one of the greatest drivers in race car history. And the Monaco Grand Prix, for those that don't know, is famous because, well, it's one of the most famous courses, but it's famous because right before the finish line, there's a tunnel. And as you go underneath this tunnel, you can kind of see, and then you go into the tunnel, and when you come out, sometimes you can be blinded by the sunlight, depending on what time of day it is and how the sun works. Now, anyway, in 1950, he was leading the race, Juan Manuel Fangio was, and as he went into this tunnel, he could just sense something was wrong. And the reason was, as he got out of the tunnel and on the other side where you really couldn't see what was coming up in front of you, there was an accident, a wreck, a multi-car accident. And he actually started to slow down before he went into the tunnel. And because he did this, he came out the other side, slowed down, missed the accident, went on to win the race. And after the race, they came up to him, the reporters did, and they asked how he knew to slow down before the race. Before the tunnel, before he got on the other side of it. And he said the reason was, as he was driving, he could see out of the corner of his eyes all the spectators were not looking at him, they were looking in front of him. You could tell by the way the colors on their shirts and on their jackets. And it's interesting because he said at the time he didn't even really realize it. He just reacted to that. And it's interesting because it's kind of his body's way with enough experience and enough knowledge that he knew something was wrong. And I think when it comes to trading in general, the more we trade when it comes with ETFs and various sectors, we can try and be as automatic as we want and use computers, but at the same time, there is a gut part to this, to all of this. And I think this is a really good example of that gut. With enough experience, you just kind of learn sometimes things aren't right. Things don't seem right. George Soros, obviously one of the most famous investors of all time, he is famous for any time he has something wrong or he doesn't feel good about a certain deal, his back flares up. And he's been on record and said, when his back flares up, that's usually his body's way of telling him something is right. He might not know what it is, but it's his body's way of telling him that something is wrong, and he just simply knows that it's time to maybe take a step back and reevaluate things. So there are edges, I think, when it comes to what your body's telling you that we all need to listen to. Now, examples of this. Within hours of the major market peak in October 2007, there was a Wall Street Journal article talking about exercising ghosts of October's past. It talked about how crashes such as 1987 are likely to stay memories. And again, looking back, that was, again, within hours of a market peak, we're saying crashes are likely to stay memories. So for someone who's been around long enough, you can see those things. This by itself by no means is a reason to turn bearish. But again, when you see things like this, it makes you take a step back and think, okay, optimism in general could be getting a little too frothy here. And the flip side to that is the same day as the market bottomed in 2009, this was actually a front page article in the Wall Street Journal. It says Dow 5000. There's a case for it. And this is it talking about at the time, remember the Dow was just beneath 7,000 when it bottomed. So this is actually calling for another approximately 2,000 point drop. And looking for earnings point to 1995 levels. And what's interesting here is I'm a technician, I guess, by nature, and this article actually quoted numerous technicians that were bearish. And I can tell you, because I've been quoted in some of these before, whenever you see technicians quoted in various articles asking for their opinions, that's sometimes a chance that there will be potentially some type of a major change in trend, because usually the reporters go to the technicians when they aren't sure what's going on and there's a lot of uncertainty out there. This can be on the upside or the downside for that matter. So if you see an article in the Wall Street Journal with a lot of technicians being quoted, just be aware of that and be on the lookout. Lastly, Fibonacci retracements. These I think are very important when it comes to ETFs and sectors in general. Now, on overall stocks, I haven't seen Fibonacci retracements work quite as well. But I think that by nature, the Fibonacci retracements are meant to work on groups that have very wide people trading it, a lot of people trading it. They work usually best in the commodity world. But again, here's a really interesting example. If you look at the S&P 500, I remember the day this happened actually because it was circling a lot of trading desks in the technical world. If you look at the lows from 1982 to the recent peak in 2007, the S&P actually bottomed within 1 point of a 61.8% retracement. Now, I don't have any fundamentalists actually within 1 point of a bottom, and then nonetheless, a lot of technicians weren't aware of this. But still, it's extremely powerful, and it really hammers home. There very well could be something to these retracement, the more common retracement levels. So in your trading when it comes to ETFs, without question, retracements are something you should definitely pay attention to. The volatility scorecard. This is something I want to spend a little time on. It ranks various underlying securities based on their relative attractiveness to move relative to their options. Now, simply put, there is no directional component to this. That's something that's important to note. And this is a proprietary thing that we've been working on here at Schaefer's lately, and we're proud of, and we've had some pretty good success with it. And what it tries to do is we're trying to get a number between 0 and 100. And again, in essence, what this is doing is when we're trading options, this tells us how actively the stock or the ETF will move relative to what the options have it priced as. Now, the components to this are 4 equal parts. I'll just gently touch on these. We look at historical volatility over the past 3 months and divide it by the current implied volatility of near-month options. And again, a high score means the stock is more volatile relative to what implied say they're going to be going forward. A gap score, this is what we're looking for here, is how often a stock gaps. Clearly, if a stock gaps a lot, there's more volatility there. And, from an options trader point of view, or from just someone who wants to trade something that moves, that's very positive. The big move scores, this is similar to gaps, but what we're looking for here is how often over the past 3 months the stock or ETF has a move that's a one-day move that's 1.5. That's a 1.5 standard deviation move. And lastly, the average move score. This is the average daily move of the stock or ETF over the last 3 months measured in standard deviations. So again, there's a lot that goes into this. Our QA guys have worked pretty hard at this, and we're proud of it. Now, here are some actual results of it. When we look at the volatility scorecard, again, we want high numbers if we're going to be buying these ETFs, because again, it shows the stock tends to move more than the options have it priced at. Now, another way we've been trading, like what I've talked about earlier, has some longer-term trends, how to do longer-term trends on ETFs. But we've had a lot of success recently trading the new weekly or the newer weeklies on ETFs. Weeklies are options that come out on Thursday, and they expire the following Friday. So really you have about 7 days to trade them. And incorporating various reasons you like an ETF with the new volatility scorecard we've been working on, we found that there's been a lot of success with that. Specifically, as you look here are some of the more popular ETFs that have weeklies. The GLD and GDX and SLV, those of course are the gold and some silver names there, and they have high scorecards. So again, even though silver, you can make the argument, silver has made such a spectacular move, and the options, quote unquote, seem expensive, our volatility scorecard would actually say that's actually not the case, and still, there's still a lot of opportunity there. They're priced reasonably. Actually, just yesterday, here's a little trade I just did. Molycorp, MCP, it's a high-flying rare earth name. It's gone from about 45 to 70 in a relatively short time frame. Nonetheless, it has a 98 scorecard. So now again, that's not predicting which way it's going to move. It's simply predicting there's a lot of volatility relative to what those options are priced at. So I actually bought some calls on MCP just yesterday, and I think the chart looks nice, but again, a big reason was they seemed expensive, but the volatility scorecard says, well, no, maybe they're not as expensive as it seems.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.